All right, everybody, what's up? It is Thursday, September 3rd. All right, I got some explaining to do here. Today was an interesting day. We had, about a 5-6% pullback in the NASDAQ. We had like a 3% something pullback in the Dow and the S&P. So, let me try to break this down for you. But before I do, I just want to say something like, I focus on the macro, the big picture, and that's where I believe you can have an assessment of conditions and the market that will allow you to make big money over a period of time. But even with that, we get caught up, and I try not to, but it's almost impossible not to get caught up in the day-to-day fluctuations, even day-to-day changes in economic data, in the fiscal flows. So, I'm even susceptible to that, as is anyone who is like sitting there watching the markets every single day, or, watching the economic data. So having said that, let me get into what I think is going on right now. First of all, there's a lot of conflicting forces at the moment. Now, I've been talking about the fiscal flows. The flows are at a record level. As a matter of fact, in the latest data today, we have made a new high in the year-over-year increase in spending. So like spending's up around 6.4 trillion. We hit 1.706 trillion year over year. That is a new high. So think of it, the amount of money being pumped into the economy, number one, is a record, and number two, the amount over last year just hit another new high. All right, so that just keeps going up. Now, I spoke about the growth rate of that spending yesterday in my video, and I said it was clear that it was slowing down, or it had hit a plateau, I think was the term I used. It had hit a plateau, and it's starting to, a gradual slowdown. By any measure, it's still really, really fast at like, 35% up over last year. Last year it was up 6% or something like that, and last year was a record, and we had a great market and a good economy. So 35% is like, you got to go back to the 1940s when we were in World War II to see that kind of a year-over-year percentage spending increase. But it is slowing down. The growth rate is slowing down. Now, from a sentiment, I've been talking a lot about sentiment too. So on the one hand, we have that AAII weekly survey. And again, by the way, it came out last night, and I sent out my update this morning. Unbelievably, the individual investors are still bearish. This is 28 weeks in a row that bullish sentiment has been below the historical average. 28 weeks in a row. I went back and I looked at the period from 2007 to 2010, which included the Lehman crash and the crisis. Even within that period, you had some weeks where bullish sentiment rose at least to the historical average, if not above. We have not had that at all for the last 28 weeks. So for some reason, individual investors have been really, really negative. So I've been taking that as a bullish sign for the market. I believe eventually they're going to capitulate at some level. But here's what's going on, I think. We have a slowdown in the rate of growth of spending. Now that's like the second derivative. I talked about that. I don't think that is like a debilitating thing. And again, I think it is it's still extremely high by any historical measure. We have record spending. So the flows are going into the economy. Think of that swimming pool. If that's a swimming pool, the water level is coming up. It's coming up. But one thing that is a little cautionary right here, if I could say, and I think I mentioned this yesterday in my video. If not yesterday, I did mention it recently. Daily corporation income taxes have now dropped below the levels of last year, and that has been now for 8 of the last 9 statement days, or 8 of the last 9 business days. So the last time this happened, and I think I said this, was in the period of early June to mid-June, and that preceded a 7% correction in the market. So, I mean, we basically had that today. We had, what, 6% down on the NASDAQ, 3 something down, so we probably have some more downside here. The thing that gets me a little bit, you know, not concerned, but just pausing to think about the outlook short term. And again, I hate doing this short term stuff. I like stepping back as a big picture. The put call ratio is ridiculous. I mean, the 10-day average and the 20-day average of the put call ratio, I downloaded all the data available from the CBOE. That goes back 14 years to 2006. The 10-day average and the 20-day average of the put call ratio is the lowest in over 14 years. In other words, in that 14-year data history, we have not seen a 10-day average and a 20-day average as low as they both are right now. Now, that is a sign of extreme bullishness on the market. But again, I've been talking about this divergence between, you know, if you had been trading using the put call average, and I did do that in July, and then I turned around my position back to long, but in July that was given a wrong signal. But it's really hard to ignore that. I mean, that thing is so extremely low. So here's what I think is going to happen. I think we have some more downside. How much? I'm not so sure. I'd like to see that put call average at least get back to, you know, somewhere near a historical average, come back up again a little bit. The fiscal flows are very strong, but I'd also like to see those corporation those daily corporation income tax deposits start to pick back up again. That would be my signal. So right now, I'm saying it looks like market's going to take a breather here. We're not going to hit 30,000 Dow right now. We're going to get there. I'm pretty sure we're going to get there, but it doesn't look like we're going to get there, at least right now in the short term. I think a little bit more correction is probably in the cards. But overall, I would say the fiscal environment still looks very positive. You need to get the economy opened up more. I mean, tomorrow we're going to get the jobs report. It could be, I don't know, a weak number. They're looking for 1.4 million on the payrolls. All right. Dollar was up today. I'm selling into the dollar rally, as I said. Gold was down. I think those trends are intact. You got to buy gold. Oil was down. The EIA report actually that came out on Wednesday was a pretty bullish report. I mean, we're seeing good inventory drawdowns, and I explained, I think, that the drop in demand for gasoline, distillate, jet fuel, refiner inputs, that was all hurricane related. Remember, we had the hurricane, whatever it was, last week or the week before. They had to shut down all those refineries in the Gulf. Everything was shut in. So you'll see that flip back up to positive. So yeah, that's where we are. I mean, the thing for me right now are those corporation income tax deposits, the daily corporation income tax deposits that are now below where they were last year. So it looks like a sign of some slowdown in sales and profits. And, you know, the market is overextended here. So short-term correction, but we still have a very positive fiscal environment. I think at some point, you know, you get another good buying opportunity, and then we go higher. We're just going to keep going higher ultimately, as long as the fiscal environment stays the way it is. So yeah, that's the update. It sounds a little complicated, It is a little complicated. You know, I would love to say, hey, there's one thing to look at, and sometimes there is. I mean, I look at the fiscal flows. That to me, as I've said so many times, is the core of my analysis. But, you know, there's a lot of stuff flying around here, a lot of moving parts. I mean, that's the nature of, you know, what we do when we forecast. All right, everybody, enjoy. See you tomorrow. Bye-bye.